Hello everyone, and welcome back to this edition of the weekly video market update from FBS.com. And I hope that you guys are actually staying safe as COVID-19 cases are skyrocketing everywhere. I would like also to point out that this would be or will be my last video on the channel, but just for a while, as I will be leaving for a few weeks as I am getting married. But the written reports will remain as usual, and the videos will be back again around the end of September. With that being said, and as always, let's kick off this video with the topics that we'll be covering today. The US dollar index declined sharply after reaching the highest level since November of 2020. Is this a new trend or another short-term play? Gold prices recovered the flash crash that occurred at the beginning of this month. While our medium-term positions are still active, where do we go from here? The U.S. equities posted a new record high, including the S&P 500 and NASDAQ, despite the fears of Delta variant. We explain why. The British pound declined sharply at the end of last week's trading, reaching our entire targets mentioned in the previous video, while our short position posted over 300 pips of profit. And finally, the Aussie bounced back from a key support area, and we issued a long signal on Friday. We explained why and what are the possible targets. We'll dive into the details after a short commercial break. Beginning with the US dollar index, of course, as always. The index managed to rise over the past few weeks and broke multiple resistance areas, including the 93, which was solid since March of this year. The index continued to rise, supported by positive economic releases over the past few weeks, reaching as high as 93.75. Such rally was also supported by the estimates and the expectations that the Federal Reserve will start tapering the current QE before the end of this year. And each economic release over the past few weeks was supporting such idea. But in return, markets were pricing in the tapering in advance, and this should not be a surprise to anyone. But on Friday, last week, the dollar failed to stabilize over the 93.50, which was a solid resistance area as well, and declined back and closed the week a little under the 93.50, but also formed a bearish shooting star on the daily chart, as you can see on the chart or on the screen, which was again the first signal of another leg lower ahead. Over the weekend also, the Federal Reserve, or one of the Federal Reserve members, stated that the Federal Reserve might actually need to wait a little bit longer before tapering the current QE due to the Delta variant in the States, which keeps spreading, especially in the US. In addition, the Jackson Hole Symposium is now switched to a virtual meeting due to the same reason, which basically gave the market a reason to ease on the tapering expectations. In return, the dollar declined sharply at the beginning of the week, all the way back toward the 93, which should be watched very carefully as it represents another new support area. Yet the questions remains here. Is this a new trend? Is the trend is over, or the uptrend is over, or is this another short-term play? By looking at the chart, at least on the daily chart, we can only say that this is not a new trend yet, despite the notable sell-off that we saw over the past few days, or at least on Monday. And as long as the tapering expectation is here, the dollar uptrend will stay alive. And as we mentioned before, since the Federal Reserve June meeting, it is a time for the dollar to show a stronger move, as the market will keep on pricing in the tapering decision in advance. Therefore, any downside move or any downside retracement in the US dollar index should be considered as a new opportunity, not only on the short term, but also on the medium term. Let's move from the dollar to metals this time. Gold managed to recover its entire losses that occurred during the flash crash that happened at the beginning of August. Also managed to break above multiple resistance area after getting clear support from $1,775 an ounce, and also closed Monday's trading or yesterday's trading above $1,800 an ounce. Such rally has a lot into it. It's not only about inflation, of course, it's kind of like an old story right now, but this time markets are actually rising while gold is rising too, which might be another sign that Delta variant might be more dangerous than what we thought, or than what the market thought at least, especially if it keeps on spreading the same way as if it's spreading right now. And we hope actually that it won't continue for a long time. However, what's good about this thing, or what's good about this rally at least, is that our medium-term long positions that we issued a few weeks ago at $1,730 an ounce are now in profit with over $70 for each position. And now it would be wise to move our stop even higher towards $1,770 an ounce to protect our position and our profit as well. So whatever happens now, if gold goes down for whatever reason, or there's the kind of political, but kind of like any kind of reasons like for gold to go down, we would still get out with profits. In the meantime, the technical indicators on the daily chart is still looking more encouraging, but at least they are also much better than before. And this could actually lead to another leg higher in gold in the coming days to retest the 200-day moving average, which is a little bit not far away from here, which stands around $1,810, which is also in confluence with the 100-day moving average on the daily chart. While a break above that level is needed, or those levels is needed, or at least those moving averages is needed to clear the way for further gains ahead, possibly this time towards $1,830 an ounce. Going back to the US again, but this time we'll talk about the US equities and Jackson Hole meetings. To start with, some are kind of confused on how the US equities posted new record highs on Friday and on Monday, even after the announcement that Jackson Hole will go virtual due to the fears of the Delta or COVID-19 Delta variant, whatever you want to call it. Such decisions should have a negative impact on the markets. That's from at least in theory. However, the markets took this decision as a positive factor, but from a liquidity point of view. Switching Jackson Hole meetings to virtual means that there is a clear risk from Delta variant, and the Federal Reserve, or even the health sector in the States, is taking it very, very seriously, which could also mean that the Federal Reserve might surprise the market and delay the tapering, especially if things get worse. Therefore, we need to be very careful over the next few days at least, or the next few days, on what the Federal Reserve will deliver or will say during the Jackson Hole meetings. And if the Federal Reserve sticks to its plan, the previous plan that we know is to taper before the end of the year, then the entire move that we saw at the beginning of this week at least will be reversed quickly and possibly before the end of this week. Therefore, it would be wise to trim our risk in equities at least for the next few days. Moving to currencies now, and here I would like to congratulate everybody who joined us on this trade. And of course, here I'm talking about the British pound versus the dollar trade that we mentioned in our previous video. Looking at the chart first, the selling zone back then was trading, or was between 1.3940 all the way up toward 1.40, which represents the 50 and the 61.8% Fibonacci of the previous downside move, as shown on the chart. But we were able to take only, unfortunately, but that's still a good thing, we were able only to take one position, which is the 1.3940, as the British pound couldn't make it to 1.40 and declined before filling our pending orders back then. The pair also declined back gradually at the beginning of it and traded within kind of a tight range for a few days before declining sharply in the past week, reaching our entire targets first and even more than that. The pair declined all the way toward 1.36, which means that the move was over 340 pips since our entry, or since the signal that we sent out. And we also mentioned in our written reports that last week that it would be wise to close more than 90% or even 90% or even all the position after reaching that level, And at the same time, to be honest, I decided to close all the position around one spot 36.33. In the meantime, the British pound bounced back off of one spot 36 as it represents another support, and a double bottom might be in progress, while the technical indicators are not strong enough, at least for the time being, for us to jump on a new trade. Therefore, I would stand aside and wait for new technical developments over the next few days before jumping on or deciding on any new trade. Speaking of the new trades, of course, I hope that you also joined us on our Aussie trade, the one that we issued last Friday, when the Aussie dollar was declining sharply, reaching a solid support area, and this is what we will be discussing in a few seconds. But we issued two pending orders on Friday at 0.7155 and 0.71, which is a solid support area on the medium term, which lasted since October of last year. The pair declined all the way down towards 71.06 before bouncing back, leading one of our pending orders to be filled, which was the one at 71.55. Since then, the pair managed to rise gradually, while on Monday, the dollar weakness was the main factor to push the Aussie dollar higher all the way above 0.72, while the pair also continued to rally, at least today on Tuesday, above or toward 0.7238 until this recording, meaning that our trade so far has over 60 pips in profit, and it would be wise now also to move our stop to our entry a little, or maybe a little bit over, just to reserve and protect some of the profits. Technical indicators at the same time, they're still encouraging on the daily chart, which might lead to another leg higher, while I'll be happy actually to close my positions at 0.7250 with a net profit of 95 pips from our entry. But I will leave the rest to you guys to decide. This is it for this weekly video market update, and I hope that you guys enjoyed it. And as I said at the beginning of this video, I will be away for a few weeks and I might not be able to do the videos as always, but we'll keep you, of course, posted, and we'll keep you updated within our written reports as always. You can also subscribe to this channel to get notified once there is a new video on the channel from our team members. Follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economical leases, reports, and analysis. I'll see you once again in a few weeks. Stay safe and see you next time.